David Weiss, business reporter for the Washington Post. Your front page story this morning leads off with, Wall Street breathed a sigh of relief yesterday as a widely feared stock market disaster failed to materialize. Well, first off, why was the disaster feared and why did it fail to materialize?
Well, Lou, the disaster was feared yesterday because last Friday was the third worst day in stock market history. The Dow Jones Industrial Average plunged 140 points on Friday. And the reason everyone was nervous about Monday morning was that back in October, when the stock market suffered its worst day in history on Black Monday, the previous Friday also had been a very bad day. So there was something last week that was reminiscent of that Friday to Monday sort of reaction. The fortunate thing for most traders and investors is that the disaster did not materialize yesterday. Largely, I think, because there was some buying early in the session that bolstered confidence among investors and among traders. And there was a general absence yesterday of the computer-directed program trading, which had been a tremendous factor in last Friday's decline.
That decline you mentioned has been examined in lots of different areas. Probably the one that's been most publicized is the report of the Presidential Task Force on Market Mechanisms, which is referred to as the Brady Commission. This is a thick report, several hundred pages. What did this commission conclude about that decline in October? What did they say caused it?
Lou, the commission concluded fundamentally that the stock market decline in October, the worst collapse in financial market history, was not the result of thousands of individual investors trying to rush through the gate and sell at the same time. Instead, the stock market crash was caused by a handful of very large professional institutional investment firms who all pulled the sell trigger at once.
How did we get to the point where those few large institutional investors could affect the whole market so significantly?
Lou, I think there are a couple of reasons why a few investors could affect the whole market so significantly. Over the last 2 decades, large institutional investors, pension funds, commercial bank trust departments, and others have come to dominate stock trading. It's no longer the province of the little guy that it once was on Wall Street. So we've had a growth in institutional trading and institutional dominance for more than a decade. What changed recently was that these institutions began to adopt computer-directed trading strategies that lead to violent swings in the market, which are exacerbated by trading in both stocks and products known as stock index futures, which are traded primarily on futures markets in Chicago. The dangerous sort of plunge that we had in October was caused by the fact that these large institutional investors all utilize the same portfolio insurance and stock index arbitrage strategies so that they all try to rush through the gate at one time. As the Brady Commission task force pointed out, it's as if someone yelled fire in a crowded theater and everyone tried to rush through the door at once, and there's only so much room.
Good morning and welcome to this segment of our program. We're going to spend the next 45 minutes talking about the recent news from Wall Street and the stock market, and what government policy should be, whether the government should be regulating the trading of stocks and commodities. I invite your phone calls. You see the phone numbers across the bottom of your screen. We'll go to the phones in just a few minutes. So call now. Our guest for the next 45 minutes, David Weiss. He's a business reporter at the Washington Post. He's been there since 1984. And previously he worked for a year as an investment banker in the mergers department of Goldman Sachs. Talking about the Brady Commission report after they had studied what had happened, what does the Commission think the government ought to now do about it?
The fundamental conclusion and recommendation in the Brady Commission report is that our stock market in New York and our futures markets in Chicago have become one market. Currently, the stock market is regulated by the Securities and Exchange Commission. The futures market is regulated by the Commodity Futures Trading Commission. That lack of unity or unified regulation, according to the Brady Commission task force, exacerbated the problems in October. And their conclusion is that we need unified regulation. And they say probably that the best existing organization to do that sort of unified regulation is the highly respected Federal Reserve Board here in Washington, and that the Fed should coordinate and oversee the existing organizations and try and provide what I would call greater coordination between regulation and greater unity in the markets.
How has the White House responded to this report? Have they embraced it, or are they putting a little distance between themselves and it?
Lou, one of the most fascinating aspects of the recent Washington political scene as it relates to the stock market collapse is that congressional leaders over the past several weeks repeatedly said that stock market studies which came out of the New York Stock Exchange, the Chicago Mercantile Exchange, and others would not be as important as the Brady Commission Task Force study, because that was the study coming out of the White House. And so Congress said, this is the study that will count, this is the one that will lead us to the promised land in financial markets. I think to the surprise of many in Congress, beginning late last week, the White House began distancing itself from the conclusions of the Brady Commission Task Force. Rather than endorsing the policy recommendations in the report, President Reagan said that the report which he had commissioned was merely one of many stock market studies that was being done, and that he wanted to take a look at all of them before formulating any policy recommendations.
Now, you say to the surprise of many in Congress. By that, do you mean that members of Congress are embracing the report?
When I say to the surprise of many members in Congress, I'm referring to the fact that they had placed greater credence in the findings of the Brady Commission Task Force because they felt it had greater independence than any of the other studies underway. Nearly all of the other studies being done are either commissioned by an individual regulator, such as the Securities and Exchange Commission, or an individual exchange, such as the New York Stock Exchange. Some felt on the Hill in Congress that that meant these reports would be biased, perhaps representing the point of view of those agencies or exchanges, and they felt that this would be a more independent study. But the President, in a deregulatory era and in a deregulatory state of mind, didn't want to adopt what some felt are radical proposals in the Brady Task Force report.
We'll take your first phone call in just a moment. When we find out, you mentioned the radical suggestions. Give us two examples of what those suggestions are.
Well, I think the first one we mentioned already is to put the Federal Reserve Board in charge of the nation's financial markets. Fed Chairman Alan Greenspan has indicated already that he is not ready to take on that additional role. The Fed is in charge of monitoring the nation's banking system, the money supply, and interest rates, and is concerned that the additional congressional scrutiny that would come along with greater regulation of the financial markets could compromise its independence. The other more controversial or potentially controversial aspect of recommendation in here is that the financial markets adopt coordinated circuit breaker mechanisms. When I say circuit breaker mechanisms, I'm referring to coordinated trading halts and price limit moves, which could put a ceiling and a floor on the maximum amount that prices move in a given day. The Brady Commission Task Force calls for coordinating these circuit breaker mechanisms in both the futures market in Chicago and the stock market in New York.
Our topic this program is the stock market, what the government's role should be. We'd like to hear from you and hear what you think about what the government's role should be and whether it should regulate stock trading or not. Our guest, David Weiss, business reporter for the Washington Post. Our first call from Lansdowne, South Carolina. Good morning.
Good morning. I have a question about these institutional investment firms. I've been reading the papers, the Wall Street Journal and the New York Times, and I've never seen any mention of the names of these 15 institutional investment firms. Could your guest please name some of these firms?
Thanks for the call.
Certainly. Let me say first that the Brady Commission Task Force did not mention by name any of the large institutional investors which engaged in the heavy selling activity which the Brady Commission Task Force says caused the panic on Black Monday. However, based on reporting that we have done at the Washington Post, I can tell you that two of the largest sellers on Black Monday were Fidelity Investments, a large mutual fund company based in Boston, and a division of Wells Fargo Bank, the San Francisco-based commercial bank, which engaged in heavy portfolio insurance selling.
San Diego, good morning.
Hi. I just want to give you a suggestion, which I'm very happy to give because I think it's logical, help rationalize the market. My shoemaker asked me a few days after the crash what happened, and I told him don't worry. It was just program trading because you had an imbalance of orders caused by too many big holders trying to dump all at once, and that it didn't reflect real market, the value of the stock or what the economy was or what the general psychology of the public was. It was just, computer programs all trying to sell in a microsecond. So what you need to do to solve it is a regulation which says that just as, like when a new company goes public and the insiders can only sell a certain percentage of the previous time period activity, in one day or 1 month, you need a similar kind of a limit so that part of the price that a big institution will pay for holding such a large block is if they want to dump it, they can't be allowed to cause this much trouble and dump it all at once. It's a very simple solution, and you don't need, things like a limit move down in stock, that might be all right, because, what can really be the harm of having so much of a limit move, a limit on going down too much? But increase the capital of the specialists would be another help. But the main thing is this limitation on how much any one big player can dump at one time.
Okay, San Diego, we'll let you go with that thought and get Mr. Weiss's response.
Well, I think that the idea of limiting the maximum amount that anyone can buy or sell in a single day runs against the free market philosophy which has dominated the years of the Reagan administration, and I don't think it would have the backing of White House leadership.
Indianapolis, good morning.
Good morning. How you doing?
Good, sir.
Yeah, I got a comment and I'd like to have a question. I was just thinking about, I just heard him mention the word Black Monday, and I just wanted to know why. But don't answer my question right now because I'm not finished. I don't want to know why you call it Black Monday. I was born in the South, and I know the white people used to tell their children that all black people was bad. Now, I know that you're not saying this to be racist or prejudiced or anything. Now, I don't believe that. But it can perceive that way over into that era. So I just like to know what your comment is.
Okay, Indianapolis, thanks for the call.
If you go back in history about 60 years to 1929, when the stock market crash occurred, which preceded the Great Depression, you'll find the answer to the caller's question.
Marina, go ahead.
The reason is that the worst days in stock market history in that era were also referred to as Black Tuesday, for instance, in October of 1929. And so the origin of the use of the name Black Monday really had a historical root in the crisis that occurred in 1929.
Marina Del Rey, California, you're on C-SPAN.
Yes, good morning. It's early out here, but we'll do our best. I've got 3 quick comments and a question. First of all, to say that Congress would respect the Brady Commission report because it, quote, came from the White House is absolutely, positively ludicrous. Number 2, to say that the Federal Reserve is, quote, well-respected. I don't know who you're talking about. Sometimes they're well-respected, sometimes they're not. These people are just human beings. They don't know any more about the stock market than anybody in this country. We all have our opinions. But I'll tell you who the real culprit is, and I'll see if you agree. There's a man named James Baker who formulated all the strategies and all the policies with his pompous air. He has no qualifications. All his policies are blown out the door. He should leave Ed Meese alone, and what do you think? Thank you.
I think that a stock market collapse like the one we had in October is a result of a lot of forces, and I would not put the blame for a stock market collapse on Treasury Secretary Baker or any other single individual.
He talked also about the earlier observations about the Federal Reserve and its qualifications. The Brady Commission suggests that they might be the ones to control the stock market.
I think that the Federal Reserve Board is as respected a government regulatory body in the global financial markets as we have in the United States of America.
If you just joined us again, we're talking about the stock market, the government's role in regulating stocks. Our guest, David Weiss, he's a business reporter with the Washington Post. Been there since 1984. Previously worked for a year as an investment banker in the mergers department of Goldman Sachs. He also worked at the Nashville Tennessean. Has an MBA from the Wharton School at the University of Pennsylvania, an undergraduate degree in international relations also from Wharton, and is originally from Nashville. Our next call from Providence. Good morning.
Hi, good morning, guys.
Good morning.
I would like to say, as far as it goes about, having something to regulate, what should be done to, keep a watch. I would say that I'd like to see that what they would do is with the brokers is review them a couple of times a year, go over their reports with the files that they're doing, their clients, and just to check up on them a couple of times a year, maybe twice a year, maybe randomly. Because I think that's more or less the way to do it, because I'll tell you, they get away with a lot. I had a very unfortunate experience, and a best friend, my best friend took advantage of my ignorance. He's a broker, he's not even licensed, and I took his words for it. I didn't know a margin call from a S&P, I had no knowledge at all of it, and he just told me not to worry about a thing. He'd take care of everything. He told me not to even read about that stuff. Don't even worry about it. And he kept calling me up, telling me, send me another $10,000. I wound up sending him $40,000. And all he did was leave the money in there from, I had I guess those S&Ps. He left them in there for 3 months without touching them. So everything, this went from like February, March to June 19th. And I'm going to file charges. I've just been so brokenhearted, I haven't had a chance to even get myself up to even making a move yet. Didn't refresh me.
Okay, Providence, thanks for the call. In your reporting on this issue, have you run across other people like that who are in the same situation with their brokers?
I think one of the great things about the capital markets in the United States is that for years investors have felt they were the fairest, most liquid markets, meaning that trades could be executed at fair prices. And I think one of the great travesties in the 1980s bull market has been the degree to which too many brokers have pursued sales of stocks and options and other financial products that really were inappropriate for the people they sold them to. When I say that, I think of a specific rule that exists in the brokerage industry. It's the know your customer rule. Before a stockbroker sells a product to any individual investor, he or she is supposed to be fully aware of that individual's financial situation and is also supposed to be sure that the individual understands the risks of any given investment. Unfortunately, in the reporting we've done at the Washington Post, we've seen far too many examples of individual investors taken advantage of by hungry stockbrokers who are looking to make a commission. So I would caution everyone who gets a telephone call from a broker to ask a lot of questions, to be very skeptical, and to treat your money with a tremendous amount of respect, because it's a heck of a lot easier to lose money overnight than it is to make it.
Your story on the stock market is the front page story today on the Post. Do you have any say in whether one of your business stories ends up on the front page? Do you push for that usually? How's it decided that your story ended up on the front page today?
Well, the Washington Post has a system where the senior editors of the newspaper hold meetings twice a day to review the stories that are being prepared by each of the sections at the Washington Post. That would include the business section, the national desk, the local metro coverage, and the style section. Out of that meeting comes a conclusion of what will appear in the next morning's front page. Prior to that meeting, each of the reporters tells his or her editor what stories they're working on for the next day. And we have an opportunity, if we think it's a really hot story, to say, we think this is a very important story, maybe even a page one candidate. The final decision is up to the senior editors of the Washington Post, who saw fit this morning to put the market story on page one.
Are you at any kind of disadvantage covering Wall Street because you're in Washington and not New York?
I spend a tremendous amount of time in New York, and I think the fact that I am in both, and I spend time in both Washington and New York, helps me cover both Wall Street from a financial point of view and Wall Street from a regulatory point of view out of Washington.
San Diego, good morning.
Yes, good morning. I
morning.
think C-SPAN is the most educational channel that is on. I am a 61-year-old widow. I have about $10,000 in savings, and I'd like to know if I should invest in stocks now and how should I go about it, or if I should.
Thanks for the call, San Diego. That's a tough question.
I think that the best thing you can do with your $10,000 in savings during the period of time we're going through right now is put your money in the bank. If you don't need access to the cash immediately, maybe considering a certificate of deposit rather than leaving the money in a money market account would give you a slightly higher rate of interest. I think we are in a very, very uncertain time in the stock market right now, and I don't think it's a place or a place for the individual investor who is not sophisticated and who is not willing to invest for the very long term to journey at this moment. The degree of investor nervousness is very high. I can relate one story that I came upon yesterday which indicates just how uncertain a time it is. A local stockbroker, Bonnie Wachtel of Wachtel & Company, told me yesterday that she called one of her clients to invite her out to lunch yesterday. Before she could invite her out to lunch, the client picked up the phone and said, "Oh my God, I'm terrified that you're calling me. If you're calling me, it must mean the Dow Jones Industrial Average is down 600 points. I'm just a small client." Of course, Bonnie reassured her she was merely calling to invite her out to lunch. But I think that story, magnified many times across this country, is representative of the investor nervousness in the financial markets these days.
Pompano Beach, Florida, good morning.
Yeah, this is Pompano Beach. I was calling in reference to a article that appeared in Barron's Financial Magazine. I think it was dated December 28th, and talking about short sales that were made on the Black Monday on downticks. And it's my, I guess, history that I learned that President Kennedy's father was one of the first heads of the SEC.
That's right.
And the one rule that he put in was that there couldn't be any short sales on downticks in the market. And yet Mr. Martin Mayer, that wrote for Barron's Financial Magazine, said that short sales on downticks on that particular Monday were prevalent. Do you have any information on that?
Thanks for the call, but before you answer that, you need to explain to me what short sales on downticks are.
Okay. A short sale involves the sale of a borrowed stock. In other words, I can pick up the telephone and call a stockbroker and say, "I'd like to sell short 100 shares of IBM." When I sell short, I'm making a bet that the price of IBM stock is going to go down. My strategy is that I will later buy back the shares or buy the shares of IBM stock on the open market at a lower price. By buying the shares later, I will cover my short position, which I initiated. By buying them at a lower price, I hope to profit since I sold them short at a higher price. The caller's question relates to a rule on the New York Stock Exchange which says that anyone selling stock short can only do so on an uptick. An uptick means that the last trade indicated a higher price. The reason this rule was put into being was to prevent so-called bear raids on stock. A bear raid takes place when a number of short sellers who are aggressive gang up and all begin to sell the same stock short, continually driving the price down. As you can imagine, if a stock is trading down and everybody continues to sell it short, the stock may continue to plunge as everyone bets it will fall, fall, fall. There is some indication that on Black Monday, the uptick rule, which prevents short sales at any time other than a time at which the last sale of stock produced a higher price, is prohibited. And there's some indication that on Black Monday that rule was not observed as scrupulously as it should have been by some on Wall Street. It's a matter that's currently under government investigation.
There's an old saying on Wall Street that the market is driven by either greed or fear. Do you agree with that?
I think that there is no question that the emotions of greed and fear are responsible for a lot of what we see in the financial markets. I think greed and fear tend to state the extreme positions at any given time. I think what we have in the financial markets, frankly, right now is neither greed nor fear, but confusion.
Boston, good morning.
Hi. Perhaps what you just said about greed and fear may add something to my question. I'm basically interested in knowing, we hear so much about the business of the market discounting certain facts and news that may be sort of expected or forthcoming. My question really then becomes one of how far in advance can we project this discounting to actually show its effect in the market? In other words, sooner or later, you can discount something that may or may not need to be discounted and say that was part of the reason for the market doing what it did. So maybe you could shed some light on that. Maybe the fear and greed aspect has something to do with it, but it's sort of becoming a question of whether or not it's actually important anymore to consider something as having been discounted.
Well, I think that's a very interesting question. There's a theory in the financial markets that all information available to investors is immediately processed and efficiently priced, which means that all stock prices go to their proper level either when information becomes available or when there is an expectation of future information. In reality, I think some investors have done very well over time because they don't believe that all information is discounted efficiently in stock prices. So I think that the theory, which sounds very good in the classroom, doesn't hold up in the marketplace.
Tucson, good morning.
Hello, Mr. Vice.
Good morning.
I just have to agree with the gentleman from San Diego who did not have any respect for the Federal Reserve Board, and neither do I. That would be like putting the fox in charge of the chicken coop. You know, I just must say that you seem to be very naive to think that the Federal Reserve is not the kind of group of men that would not take advantage of that situation. It's just that the Congress can't even audit their books. Come on, let's get serious here. They won't even show the books of the Congress. And now you want to give them the oversight over the stock market?
Okay, Tucson, thank you.
2 points I would make. First of all, I didn't endorse the recommendation in the Brady Commission report to put the Federal Reserve Board in charge of the stock markets. Second point I would make is that the Federal Reserve Board is not interested in taking on this new role that the Brady Commission task force has recommended. Fed Chairman Alan Greenspan and other high-ranking Fed officials, I am told, have indicated that they really are not interested in expanding the Fed's authority over the financial markets.
One of the news stories in reading about the Brady report, someone commented that they thought it would go the way of the Grace Commission, that the White House would read it and then we'd never hear anything more about it. Do you think that's going to happen?
I think that just as important as the recommendations for policy changes and Wall Street reforms in the Brady Commission report are the analyses contained in the Brady Commission report. It's my expectation that the Brady Commission's analysis of what took place in October will lead to certain changes in the future in the securities markets. I'm not certain, and I don't think anyone is highly confident today, that the specific policy recommendations contained in the Brady Commission task force will be adopted anytime soon, especially because this is an election year.
Selma, North Carolina, good morning.
Yes, sir. This is my first time calling in. I enjoy your program very much.
Glad to hear from you.
And I would like to ask two very simple questions. Why not, why should the average person who has no money invested in the stock market worry about the stock market? Why not require that all pension funds be invested in government bonds with a sure rate of return and kept out of the stock market and allow the stock market to fluctuate any way that it wants as long as investment money is in this fund?
Okay, thanks for the call, Selma.
Well, your first question is why any individual investor who doesn't, or any individual who does not have a lot of extra cash should be worried about the stock market. I would say there are enough things in life to worry about without worrying about the stock market, and if you're not actively involved, I'd agree with you. Maybe it's better to spend your energy thinking about other things. I would add to that, though, that the stock market fundamentally is a barometer of confidence in the future. Every day investors buy and sell stocks in part based on their expectation about what the future of the nation's economy or the future of individual industries or companies will be. So to that extent, I think the stock market is as a barometer of confidence is an important indicator. Your second question about why pension funds should be allowed to invest in the stock market, I think can be answered using data. Fundamentally, pension funds which invest cash in the hopes that individuals will have money available in retirement have turned in superior performance investing in stocks than they would have investing in bonds in recent years.
The caller was just asking about you said the average person who's not in the stock market. What about the average person who might have a little money? Is the stock market changed forever because of the power of these institutional investors we talked about? Is it still a place for an individual investor?
I think the stock market is still a place for some individual investors, and I think that many individual investors have decided that rather than go it alone, rather than trying to pick individual stocks on their own, the best way for them to participate in the stock market is by investing money in mutual funds, which then pick stocks or individual industry sectors to invest in for them. I think we see an increasing number of individuals participating in the stock market through these mutual funds, which gives them the benefit of professional money management.
Ron Concona, New York. Good morning.
Good morning, gentlemen. I would like to ask if the Brady report addressed what the traders themselves have done in this, especially Black Monday and preceding, and how their actions in building inventories affects their fiduciary relationship to the buyers and sellers.
The Brady Commission Task Force has at least two things to say about the behavior of traders in October. The first is that the specialists who operate on the floor of the New York Stock Exchange and who have as their responsibility making orderly markets by buying when the public is selling and selling when the public is buying did not live up to their mandate. In fact, in and around the period of the stock market collapse, while prices were plunging, the specialists on the floor of the New York Stock Exchange were net sellers of stock. And I think that is to some extent, raises questions about the specialist system which have not been adequately answered to date.
Seattle, you're on with David Weiss. Good morning.
Good morning.
Good morning.
Hello?
Go ahead.
I'm calling from Seattle, and I'd like to know why they get so upset when the stock market goes down and nobody gets upset when it goes up so rapidly. Because last year it went up as rapidly as it went down, and to me it's just seeking its own level, and the stock market is still a good value for small investors. If you buy and just hang on. I'll hang up now. Thank you.
Thanks, Seattle. Interesting point.
I think that's a terrific observation. I think that the same sort of computer-directed selling that sent the stock market plunging in October and that set the stock market plunging last Friday drove the stock market up to unrealistic heights before its fall. And I think that's a very good point, and I think that the caller is correct that the best way for an individual investor to participate in the market is as a long-term investor.
Minneapolis, good morning.
Yes, good morning. I'd like to ask a question of your guest. Has you ever heard of the person named William Greiter?
Yes.
You have?
Yes.
And he works with the Post, right?
He used to work for the Washington Post.
Okay. In national affairs? All right, Mr. Greiter has come out with a very important book. It's almost 800 pages long. In the front of it, Secrets of the Temple, quote, how the Federal Reserve runs the country. Have you heard of this book yet?
Yes, sir.
What is your opinion of it?
I haven't read the book, so it's difficult for me to comment on it.
Minneapolis, have you read the book, and what do you think of it?
I just got a hold of a copy, got the last one off the shelf, and this man is zeroing in on America's problem. We have a private corporation running America called the Federal Reserve Corporation. It's an eye-opener, and he does name the Trilateral Commission as the culprit, which is a prodigy of the Council of Foreign Relations from England. We have an English bank here running this country, basically, with a few American lackeys. I suggest you read it and have Mr. Greeter on your show.
Okay, thanks for the call. It's a little late for you now, but he was on our program. He spent about a half an hour with us just before the holidays, when the book came out, and we aired that program several times on C-SPAN. You have to stay tuned to see if it'll air again. I doubt if it will, but periodically when the books come out, we do have the authors on, and Mr. Greeter was with us several times over the holidays talking about his new book. San Rafael, California, good morning.
Yes, good morning. I wanted to make a comment that your guest there mentioned the mutual funds. They took a terrible beating in October. They weren't any better than anything else. But I do have a question, a comment first. I've been investing in the stock market as an individual for a long number of years. I used to be able to go out and look at the management of the company and see that if they were well run and they were paying a decent dividend, and you invested your money, and you enjoyed a pretty relatively stable market is what you had.
Right.
Now, the next thing that come along a few years back was they bamboozled the public, and you're helping to do that, by the way, this morning by referring to the stock index futures as portfolio insurance. That is garbage. And the very minute that I saw that they were going to allow that turkey shoot to be put on exchanges, I got out as an individual investor, and I will not get back in as long as that exists. Now, you tell me what would have been the incentive for a lot of these ARBs and the big funds to have sold, to have that massive sell-off. They would not have done it had it not been that put options were so dirt cheap that they made a killing on those put options.
Okay, San Rafael, another kind of technical question. We just have a few minutes left, so I'm going to let you go with that since it's getting kind of technical, but perhaps David Weiss can quickly make it easy to understand.
Well, I think there were two major groups of big sellers early on October 19th, the day that the stock market collapsed. One was the mutual funds responding in part to requests from individual investors for cash. The other was institutions utilizing portfolio insurance theories which say that in a declining market they should be selling shares, and they follow strict mathematical formulas which lead them ironically to sell into declining markets and to buy into rising markets.
Media, Pennsylvania, good morning.
Good morning.
Good morning.
Hello, am I on the air?
Yes, sir, go ahead.
My question refers to your advice to the lady from San Diego, 61 years old with the $10,000. You suggest she put her money in CDs. 3 years ago, I put my savings in Treasury bills, which are about the same thing as CDs. My question is, how do you protect yourself when you do that from the fall in the value of the dollar and inflation?
Thanks for the call.
I think that's a very good question. I think that in a period of high uncertainty and high market risk like we're living through now, the greatest emphasis for any individual investor has to be on safety of capital and preservation of capital, so that I think putting your money in a certificate of deposit in a federally insured bank will give you great security. You'll know where your money is. You'll know that it's federally insured. And I think that protecting yourself against foreign currency risk and protecting yourself against inflation, which is not currently raging in the American economy, are secondary concerns.
At the beginning of the program, we talked about investors from Friday to Monday and anticipating what might happen. As we wrap up here, what can we look forward to this week in the stock market?
Well, the stock market this week is going to be focusing on Friday's release of the merchandise trade deficit figures. The merchandise trade deficit figures to be released on Friday will tell us in December what the United States balance of payments situation looked like. In other words, how much more did we import than we exported? In the October stock market collapse, one of the triggering events, according to the Brady Commission, was the announcement of a higher than expected merchandise trade deficit. And all market professionals I spoke with yesterday say they are focusing on that number this week. If that number is substantially higher than $16 billion, one market analyst told me, watch out below.
Is that the story you'll be working on today?
I think we'll be keeping a very close eye on it. Certainly, everyone is very interested in that number. Everyone would like to be the first to report what that number will be, and you can bet that we at the Washington Post will be working hard to give our readers that information on as timely a basis as possible.
Our guest has been David Weiss, business reporter with the Washington Post, been with the Post since 1984. We'd like to thank him for being with us, and also thank you for your calls and your comments. Have a good morning.